All right, welcome everyone to a Chat with Traders community event. Today we are live with Yvan Byeajee. He is the man behind Trading Composure and was recently interviewed on episode 252 of the Chat with Traders podcast, where he discussed with Ian Cox about uncertainty in the markets and a bit about his teachings in his program on Trading Composure. You can find him on all social medias and also on his website. Thank you for joining us, Yvan. And we are discussing today, going further into depth into the topic of market uncertainty. If anyone has any questions, please hold those until the end. We will have a Q&A session after he is done with his presentation, and we will take questions after he is done. So thank you for joining us, and I will pass it over to you.
Yeah, thank you so much, you guys, for having me on. I mean, it's a pleasure to be here. I've been wanting to do this because following my appearance on the Chat with Traders podcast, I felt I glanced over the concept of market uncertainty in a way that wasn't necessarily helpful or enlightening to the audience. And so in the spirit of providing value, I'm just super happy to that you guys gave me this opportunity to sort of a deep dive, into the topic of market uncertainty and to hopefully leave a lasting impression on the audience in that regard, because look, this is so important. Okay, I sincerely believe that most traders fail to be consistently profitable in the market because they haven't fully internalized, they haven't fully integrated, right, this idea of uncertainty, this understanding of uncertainty. And well, it's not just what I believe, the data suggests that. All right. And yeah, I mean, I'm excited to delve into this, and this time around I have slides, and this will help me stay on point and not ramble on and on too much. I have the tendency to do that, especially when I speak in public, because of nervousness. I'm a human being. I have fears. I have insecurities, and I'm learning to work with and through them. And look, I'm a trader at the end of the day. I've been in the market for 17 plus years, and I've been studying financial markets for at least 20 years. I mean, that's what I do. That's what I like to do. And at the core, I'm just a big introvert, and trading fits me perfectly because, I don't have to go out there, and I work for myself, by myself, and it's amazing. But in recent years, I've been sharing my thoughts online about my experiences as a trader, what I think works, what I think doesn't work. And surprisingly, or unsurprisingly, this has gained a lot of traction online. I mean, I have a pretty big social media following because people find value in the insights that I share. And yeah, I mean, here we are today. But yeah, anyway, what I mean to say is that I'm not a trained public persona, right? I'm just a simple guy who's done very well for himself in trading, and I say this with a lot of humility. I've been very fortunate like that, and over the years, I've built myself a good reputation as a trading psychology coach or consultant. And yeah, I'm just sharing my thoughts very simply, and I'm very excited to be here. So if that's okay with you guys, I'd like to start the slides.
Absolutely. Let's dive right into it.
If you don't understand the concept of market uncertainty, if you don't embrace it, if you don't embrace the concept of uncertainty, you will continue to struggle in trading. Let me say this again because this is really important. If you don't understand the concept of uncertainty, if you don't embrace it, you will continue to struggle in trading. Are you guys still seeing my slide right now?
Yes.
Okay. Fine. Okay, I can see it now. All right. So yeah, if you don't understand and embrace the concept of uncertainty, you will continue to struggle in trading. And I'm saying this as a trading psychology coach, but perhaps more importantly, I'm saying this as a seasoned trader, as a seasoned risk manager. So let me put forward a few propositions, okay, that I'm sure we can all agree on. First, the market is an incredibly complex and dynamic system that is constantly changing in response to a wide range of factors. I'm sure we can all agree on that, right? Second, the markets are characterized by trends and cycles, pretty straightforward as well. Third, it's not difficult to determine when a longer term trend is in place. I mean, a child could figure this out, right? If the trajectory is up, it means that we're in a bull market. If it's down, it means that we're in a bear market. Very simple. And as a trader in general, not always, but in general, you want to build a strategy that goes with the natural flow of things, of price, and so that you're not fighting the trend, that you're not traveling against the wind. So those three propositions. I'm sure we can all agree on them, right? So once again, first, the market is an incredibly complex and dynamic system that is constantly changing in response to a wide range of factors. Second, markets are characterized by trends and cycles. Third, it's not difficult to determine when the longer-term trend or cycle is in place. Now, let me make a fourth point that some will perhaps find, contentious. The outcome for any single potential trade is random. The outcome for any single potential trade is random. Now, how could this be, right? I mean, I can hear some of you thinking. So you're saying with one side of your mouth that there are long-term trends and cycles and that those are broadly predictable. And yet on the other side of your mouth, you're saying that trade outcomes are random. How does that make sense, right? And fair question. We'll get into that. So while it is true that there are long-term trends and cycles in the market, there is also a great deal of uncertainty in terms of short-term price fluctuations. There's a great deal of uncertainty in the market in terms of short-term price fluctuations, meaning fluctuations happening on a moment-to-moment basis. And one of the key factors that make moment-to-moment price fluctuations in the market so uncertain is just the sheer number of market participants and the diversity of their interests and motives and goals and assumptions and beliefs. So this is what makes short-term price fluctuations so quote unquote random, so unpredictable. The market is made up of millions of people, okay? Traders, investors, institutional players, algorithmic systems, and other market participants, casual or professional, each of whom brings their own unique perspective and approach and motives to the market. And think about it, these participants are not operating in a vacuum. They're all responding to a wide range of internal and external factors and a wide range of micro and macro factors that influence their behavior and decisions. And that's what determine prices moment-to-moment fluctuations. And I mean, this can be compared to the movement of a swarm of bees. If you were to look at an individual bee in a swarm, you would, that bee would seem to move in random directions, influenced by its own, instincts and the behavior of other bees around it. But look at the swarm and you will get a general idea of the overall direction. So what I mean to say is that, and I hope you're following me here, markets have long-term trends, okay? Market have long-term trends and cycles, yes. And those are broadly predictable, yes. But when it comes to the moment-to-moment price fluctuation, there's a great deal of unpredictability that stems from the fact that we can never know for sure who is going to come into the market and bid the prices up or offer them lower, and with what kind of financial power. Very important. With what kind of financial power. This means that, even if you have a well-researched trade idea or thesis, there's always the possibility for that trade to be invalidated by just one person or a group of people who have beliefs, assumptions, motives that are different than yours. And if they have enough financial power, they will move the market in a way that will invalidate your trade. And the thing with financial markets is that you don't know how long that new trend is going to last, because people are always mimicking each other like a swarm of bees or a flock of bird or sheep, right? So when price is pushed in one direction, it could have legs or it could be short-lived, but the more you zoom out, the more the global macroeconomic forces tend to take control again. So there's an element of uncertainty in the market. This is what I mean by uncertainty, and look, I know I'm repeating myself a lot here, and I'm doing this on purpose because this is important. Once again, there are factors that can influence price, and many of these factors are beyond our control. They're beyond our control. So suppose you get a trade signal, or you do your analysis and decide that now's a good time to enter a trade. There's always the possibility that another trade or a group of traders could enter the market and drive prices in the opposite direction, making your trade unprofitable. Okay, despite the fact that your analysis is technically sound, that's uncertainty. Okay, and in addition to that, the speed at which information travels with the internet and and all of that can also exacerbate uncertainty. With social media platforms and other platforms providing instant access to information, news, market updates, and all of that, traders can quickly respond to changing market conditions, making it difficult to predict how price will fluctuate from one moment to the next. That's uncertainty. Okay, so please, I implore you, let that sink in. This is very, very important, because if you don't understand what uncertainty is and what it means in terms of the market and in terms of your trading strategy, you'll continue to approach trading with the wrong expectations. Okay, this is super important to understand this. If you don't embrace uncertainty, if you don't understand it, right, if you don't accept it, you'll continue to approach trading with the wrong expectations. And those wrong expectations will continue to generate emotionality and trading errors of all sorts, like, I don't know, going into trades with too much size, or hesitating, or letting losses get out of hand, or closing trades too early, and so on and so forth. This is because somehow you believe that you think what's going to happen next in the market. But as we've established, there's uncertainty. On a moment-to-moment basis, you don't know who's going to come into the market and bid the prices up or offer them lower, and with what kind of financial power. And if those players come in with a big enough position size, with a big financial power, they're going to move the market in a way that will make your trade unprofitable. And this is not something to be fearful of. It's something to understand and to appreciate, and because it leads you to better manage your risk on a trade by trade basis. But we'll get into that. And Oh, and by the way, I'm not the only one to talk about this, okay? Many others, way more intelligent than me, have talked about this idea of market uncertainty way before me, okay? Serious papers have been written on it as well. For ages, people have been trying to decipher the the complex interplay of supply and demand and beliefs and human behavior to determine where price could go. Okay, because if you could figure this out, I mean, there's a lot of money to be made there. There's a lot of money on the line, and so there are a lot of mathematical models and technical indicators that have been created, but even the most sophisticated models can't account for all the variables that come into play at any given moment, which causes price to move in one direction or the other. So uncertainty is not a concept to be accepted on blind faith, okay? Because Yvan said so, or Mark Douglas said so, or Steve Burns said so. No, you can observe uncertainty in the lab of your own life, okay, by keenly and objectively observing the market, by removing your preconceptions of it, by taking that out of the picture, by taking your emotions out of the picture, and by really seeing the market neutrally for what it is, objectively. Okay, and so this idea of uncertainty, it's not one person's idea. Okay, it's a universal truth. It's an observable truth. Okay, you can observe it in the laboratory of your own life. Now, next slide. Uncertainty isn't a problem. Uncertainty isn't a problem. That's another point I want to drive home. Uncertainty really isn't a problem. Uncertainty is precisely what makes trading worthwhile, right? Look, the market hands us opportunities coupled with risk. That's what it does. And remove the element of risk, and you also remove the opportunities. Reduce the risk, and you also reduce the opportunities. Actually, this reminds me of a tweet I sent out a few days ago. I'm sure you guys have watched the movie The Big Short. Great movie, by the way. Like anyone, I loved it personally. But often what you see happen is that folks watch the movie, all right, and they get inspired by it to try their hands at trading and investing. But based on how the movie is presented, people then erroneously start thinking that those endeavors, trading and investing, are all about prediction, when they're not. Okay, they're not about prediction. Look, Michael Burry's track record is impressive, no doubt. I looked at it personally. He's made great money for himself and his clients from 2001 to 2018, I believe. Don't quote me on this. But I mean, great track record, performance-wise. That said, Michael Burry is also wrong a lot with his predictions. Actually, he's wrong way more than he's right. And don't take my word for it. Google it, do your own research. He's wrong way more than he's right. But this doesn't get much publicity. What sells is success stories, right? Oh, Michael Burry made close to $1 billion shorting the mortgage bond market. That's what's popular, because that's what people gravitate around, a good success story. But again, look at his track record and you'll see that he's wrong a whole lot. Okay? And listen, if big dogs like Michael Burry and Paul Tudor Jones and all the rest have had stellar trading performances, despite being wrong a lot, despite their low win percentage, then what does that tell you about what's really important in this trading game? Look, these folks, they come out on top, not because of the informational edge they have. It's not because of their superior analysis. No, they come out on top because of the asymmetric nature of their bets. Okay, this is so important. These people, these folks, these market legends, they come out on top because of the asymmetric nature of their bets. Pure and simple. On a trade by trade basis, for every dollar they risk, they stand to make $2, $3, $4, and even more. Asymmetric bets. That's what it is. And this is what allows them to be wrong a whole lot and still come out on top, on top in the aggregate. So basically they in the aggregate, they win more than they lose. And yeah, once again, trading is less about prediction. Trading is less about prediction and more about the positive expected value of your bets. No matter what you trade, no matter your time frame, no matter your trading style, no matter no matter the instruments that you trade, trading is less about prediction. Trading is less about prediction and more about the positive expected value of your bets. This means that whether you reap a loss on a trade or not, you should be willing to take other trades with those same exact parameters in the future, following the exact same rules, because they make sense statistically in terms of the risk-reward ratio, but also in terms of the thoughtfulness and the consistency behind the trade entry and exit. This is so important. If you take anything from this presentation, it has to be this: trade outcomes are uncertain, and the trading game is less about prediction and more about the positive expected value of your bets. Okay, so I mean, all in all, if you think about it, uncertainty isn't a bad thing. It's great because it creates opportunities, but it's all in how you approach it mentally. Okay, do you accept uncertainty? Do you embrace it? Do you view controlled systematic losses as a necessary part of the process of trading? So that right mental approach towards uncertainty will make a big difference to your bottom line. I guarantee you this. Now, so we talked a little bit about uncertainty. Hopefully you understand it a little bit more now. How does one accept it and embrace it now? Because make no mistake, there are two elements to understanding. There's conceptual understanding. There's the conceptual element of understanding. This is when something makes logical sense to you, and then there's what I call the experiential element to understanding. And this is when you understand something, yes, conceptually, but also, deeply with your experience. And for the visuals out there, maybe see understanding as a territory. Conceptual understanding is the map, and experiential understanding is you mapping out the territory with your own experience, body, mind, and you're actually walking the path. And this is how I like to visualize it personally. But look, in life, you need both. You need conceptual understanding and you need experiential understanding. And conceptual understanding is pretty straightforward, right? You read a bunch of books, you watch a few videos, interviews, etc., and then you sort of connect the dots and refine your understanding of things. But it's still superficial at this point. Now, experiential understanding is where the rubber meets the road. It's really the tricky one on top of that, because it requires actual experience. So long story short, what I'm trying to say here is that there's no quick fix, right? Embracing uncertainty takes time. You must come to understand it conceptually and experientially. And most traders struggle simply because they don't have that thorough and complete understanding of uncertainty. So yes, they might understand that there's uncertainty. They understand it in a loosey-goosey way, right? Because they heard trader X say so, or they read a book about it. So they understand that there's risk, there, but they still struggle because they lack that experiential understanding of it. And this is why they continue to struggle. And so, they don't have a consistent trading structure to improve. And if they do, they still fail to abide by it. They take trades willy-nilly and emotionally, and they don't consider the impact of uncertainty, and they have no real concern for position sizing and an exit strategy. It's really, if you think about it, it's a make money at all cost kind of mentality. And look, it works very well in business and elsewhere in life, but not in trading, where uncertainty is pretty high, where uncertainty is omnipresent. To be a successful trader, you have to adopt a certain consistency of thought and process day in and day out, in the very midst of confusion, in the very midst of turmoil, of vicissitudes, in the very midst of uncertainty. This means that you have to find a way to squash the voice of doubt and hesitation within you. You have to learn to deal with the finality of a loss on the downside. You have to know when to take your profits on the upside. You have to make peace. You have to make peace with the fact that you will have periods of underperformance, because no strategy will win all the time, right? They come in and out of favor, and that's just the reality of things. And you have to make peace with the fact that you will leave money on the table as well. And only when you fully prepared yourself for what could go wrong like that can you then take full advantage of the opportunities in the market. So, yeah, once again, this is easily understood by each and all, but very difficult to internalize and implement, right? It takes time, but there are definitely some things that you can do to sort of speed up the learning process. Other trading psychology coaches and experts out there will talk about the importance of fixing your beliefs around money and failure and all of that. Listen, all of this is good stuff. I'm not saying it isn't, but personally, and I'm not just a trading psychology coach, I'm also a trader. I have real experience in the market, and I have skin in the game. And based on my own experience, I've been in the market for a very long time. Based on my own experience, but also the experience of just many others that I've worked with, your most immediate concern as a trader should be to approach trading the way you approach a coin flipping game. Okay, this is super important. You need to approach trading the way you approach a coin flipping game. When you play a coin flipping game, heads you win $3, tails you lose $1. Typically what happens is that you don't attach your ego to the outcomes, right? Your emotions aren't all over the place. It's a game where there are stakes, there are risks, there's a positive expected value by virtue of the asymmetric nature of the bets. Heads you win $3, tails you lose $1. And so you don't need to fix your beliefs about money to play this game. You don't need to fix your childhood traumas. You don't need to journal endlessly, about your feelings and about how the coin was tilted, a bit on the left, and based on that, and based on the density of the air in the room and the texture of the surface, that the coin lands on, and all of that it's more likely to land on heads. No, you don't go into all of that rationalization over intellectualization. No, when you play a coin flipping game, what you do is that you place your bets and you keep flipping the coins. You keep flipping the coin without overthinking, without over rationalizing, without over analyzing the whole process. There's a certain level of emotional detachment there, right? Because you know that the coin is fair. And that each flip is basically quote unquote random, right? And so you also know that the risk reward is favorable, which makes you virtually guaranteed to make more money than you lose over the long run. Not in the short term. Very important. Not in the short term. In the short term, anything can happen, right? the coin could land more on heads or more on tails. It's all quasi-random. But over the long run, should you keep flipping that coin, you're virtually guaranteed to make more money than you lose, even though the coin is fair. It's really the risk reward framework that allows you to make more money than you lose. And so yeah, I mean, you're not overthinking things, right? You just flip the coin as many times as you can. That's what you do. And this is what trading is to Guy inherently. It's just a statistical probability game. That's all it is. But as humans, we tend to over intellectualize things and overthink things. And look, I've been there myself. I've experienced these ups and downs, and I'm a very sensitive kind of person, very emotional guy. And trading was very, very hard for me in the beginning, reaping losses, consecutive losses in a row. I mean, it was brutal, but over time, through repeated exposure to the market, and through resilience and through trying over and again, you learn to see how things work, and then you attach your emotions less to the outcome of your trades, and you understand that it's a numbers game and that you're just flipping a metaphorical coin, over and again, and you're seeing how you're trying to make money in the aggregate over the long run, not over the short term. This is a noise, there's mostly random. So that's the first thing you can do. You can shift your perspective. Next time you place a trade, imagine that you're flipping a coin. Very simply. In other words, expect uncertainty in the short term, and always manage your downside. Stay in the game. Keep flipping your metaphorical coin over and over and over and over again. Don't overthink things. Stay focused on the process of trading well, and in due time, your results will come together, provided that you don't allow yourself to take big losses, because big losses, this is what derails your long-term performance. The outcomes that are acceptable, are small losses, break-even trades, small profits, big profits. Big losses, no, you should wipe this out of your mind, of your process, of your vocabulary. You shouldn't allow yourself to take big losses. Those are the account killers, because they introduce a certain level of volatility in your equity curve that you don't need. Okay, so once again, small losses, break-even trades, small profits, big profits. This is consistency right there. If you have these outcomes, you will do very well for yourself in the long run. Okay, and look, trading is nothing special at all, and you shouldn't work it up in your mind like most people do, and like I used to do as well. If you really can take trading and place it in the same sort of mental category, you place a positive expectancy random coin flipping game in, your tensions will naturally ease, and you will trade with more confidence and more profitably. Now, so that's one. The second thing that you can do to better accept and embrace uncertainty is to meditate on it. Personally, I'm a big proponent of meditation. It's helped me a lot in my own personal life. By nature, I'm a very anxious kind of person, very neurotic as well. And so, I have no problem sharing that with my audience. I'm prone to depression too, but meditation has helped me sort of, and I practice it on a daily basis. I've been doing that for many years now. I've practiced it on retreats for month-long, month-long retreats, on month-long retreats. That's what I meant to say. And I mean, it's helped me tremendously. It's helped me manage a congenital stutter that I've always had. And now, if we had this conversation A few years ago, you would see that I wouldn't be able to form a coherent sentence without repeatedly stumbling on my words. But now it's much, much better. You know, I'm able to express my thoughts without stumbling too much. And I mean, meditation has been instrumental because it introduced myself to my own emotions and to my own fears and to my own sort of inner narrative in a way that I didn't think was possible before. And looking into those different thing within me has helped me first befriend them, and second deal with them in more productive ways. And so this is what you can do as well to help you just weather the ups and downs of trading more productively, is to pick up a meditation practice. Do it daily. You don't have to do it for extended hours, just 10-20 minutes a day. Just be with yourself and observe your thoughts and feelings, and observe how it's all constantly shifting and changing and moving, and how it's all you know, impersonal, and it's impersonal and it's impermanent. So when that insight into the impermanent and impersonal nature of thoughts and emotions and feelings and everything becomes sort of, you know, internalized within your psyche, you have a much easier life. You have a much easier time navigating this thing called life. And certainly this can help you process and accept this element of uncertainty that's present in the market, that's so difficult for most traders to accept and to deal with and to embrace. And meditation is also part of the experiential element that I explained earlier, the experiential element of understanding that you need to work on. And I've recorded a meditation for you, for the Chat with Traders audience, and I'll let Tessa or Ian decide how they want to make this available to you. But yeah, those are the two steps that you can do to sort of steepen your learning curve, and so that you can embrace this element of uncertainty faster, right? So that you can get consistent in the market faster. And yeah, that's pretty much it for this presentation. I think I've said everything I wanted to say. And Tessa, Nicholas, I'll let you take over.
Great, thank you. That was very informative. If anyone has any questions, you can go ahead and type those into the chat, and we will either call on you or relay them for you. That was really great. Thank you, Yvan. Do you think that one of our biggest issues with facing uncertainty in the market is that we live in a culture of instant gratification, where we can just pick up our phone and have food brought to us? We can look at the markets in a second. And what can we do to negate our wantings for just instant gratification to help us be more patient?
Yeah, no, that's an excellent point that you're making. It's very difficult for us to see that our lives are full with uncertainties, because we've created a society where that has created this illusion that we have certainty. Let's say, as you explained, you want food, you just open your fridge and you grab something to eat. And you want to, you're feeling bored, you just turn on the TV, just grab your phone. And so this has given us this illusion that we have more certainty in our lives than we actually do. But once again, it's just an illusion. In life there's a lot of uncertainties. There's this death. There's you could leave your house at any moment and a drunk driver could hit you. I'm touching wood. I wish you all a long and happy life. But those are the realities of life. There's uncertainty. And so it's always good to reflect on those uncertainties, so that you're not you're not living in a dream, and then when hard things happen to you, you just feel completely defeated because you didn't expect this at all. And so it's always useful to reflect on the element of uncertainty that's present in our lives, that's constantly there, and it helps you develop an appreciation for and just feeling gratitude for how things are. Things aren't that bad for you. Like for instance, I tend to overthink things a lot. It's very hard for me sometimes to be happy, even though I've accomplished some amazing things in my life. But it's like I can't even see it sometimes. I don't know if it's something with my brain. I just can't see my the level of success that I've achieved, the progress that I've made, the growth, the personal growth that I've been through, and that's fine. That's fine. But what I mean to say is that it's useful to reflect on those things that are not in our control. And this links perfectly to trading, to the market as well. The market is not in our control. It's really not. What is our trading process, our trading rules, our trading behavior. And if you can get yourself to focus on that and strictly on that, while relinquish this idea that you can predict where the market is going next, because newsflash, you can't, especially in the short term. In the long term, you can make a case for how you can predict long-term trends and cycles, and I believe you can. Right. But in the short term, as I explained earlier, you don't know who's going to come into the market and bid prices up or down, and with what kind of financial power. And so this is what makes short-term price movements so erratic. And this doesn't mean that you can't win as a short-term trader. It just means that you need to adopt a longer-term approach, a probabilistic mode of operating, and you need to be consistent in the very midst of that uncertainty, of that change. This is the only way to win. You're not going to win in the market if you're blindly following your emotions and your whims and your fantasies. What that does is that it gets you randomness. Okay, consistency gets you consistency. Consistency begets consistency. Consistency in behavior gets you consistency in your results. I mean, that's the name of the game right there. And yes, it's easy to talk about this. It's very hard to internalize it, to live it. That's why I'm a big proponent of telling traders to trade more. Some trading coaches, trading educators out there will advise their traders, their students, not to trade that much. But I don't believe in this. I believe that you should trade as much as you can with small sizes so that you don't blow up, right? Because you need these experiences to develop your self-mastery, to learn what works and what doesn't. And it's not helpful if there are weeks or months between each trades. You're not going to learn fast enough. So you need to be in the market and engage with it. Look, if you want to learn to swim, you need to swim more, not less. You can't just read a bunch of books, take a bunch of courses about swimming, and while never touching the water. Okay, you need to jump into the ocean and actually try. And try again and try again and try again. Trading is exactly the same. You need those experiences, ups and downs, profit or losses, to learn what works and what doesn't, and to get better control over yourself.
We have a question from Jens. How can I change a characteristic like perfectionism from a weakness, because there is no such thing as being perfect in trading, into a strength? Is it to be more aware of uncertainty? Or how can you turn perfectionism in your favor?
Right. Well, the thing is that when you understand, when you truly understand, and when you've internalized this concept of uncertainty, you realize that there's no place for perfectionism in trading, right? You could be in a very nice profitable trade, and then you close it, and the market keeps ramping up higher and higher and higher. You're not going to beat yourself up for missing out. You have to be content with the decision that you took, and accept your small profits and move on to the next trade. Same thing conversely, if you just took a loss on a trade and the market just hits your stop loss and just reverse and goes in the opposite direction, you can't beat yourself up endlessly for that. There's a random element to it. What you can do is that you can try again, stay in the game, keep trying over and over and over again. And what this is doing is that this is helping you develop yourself, develop your capacity to be a better trader, develop that confidence you need to be a trader, and then it's putting you in the right place and the right time to take advantage of the opportunities that the market is constantly handing you. So once again, there's no place for perfectionism in the market. And what could be helpful is to do a personality test. I don't know if you guys have heard about the Big Five personality test. This tells you, this gives you insight into your own personality, what you're more inclined to be like as a trader, right? You know, are you more are you more about, you know, this kind of person that want quick, small rewards in order to feel like they're achieving something, or are you how much of a risk taker you are, and so on and so forth. By taking this personality test, you can discover a lot about yourself and you know, about your own inherent qualities and temperaments. And so you can better, then using that information, you can better adjust your strategy in a way that espouses your strengths, so that you're not spending all your time fixing your weaknesses. You know, just find a way to leverage your strengths, what comes naturally for you as a person, as a unique individual.
Great. And then also, I think putting a term to the concept is very useful as well. And so your post last week on equanimity, it was the first time I had heard this word, and I think that would be a great discussion too if anyone had missed that last week.
Yeah.
Do you want to dive a little bit into the equanimity and what you mean by that?
Yes. So equanimity means basically when you're able to experience your thoughts and your emotions and whatever's going within you from a place of freedom. So you're not attached to what's comfortable. You're not attached to what's uncomfortable. You're just feeling everything as it is from a sort of neutral standpoint. And from that place of stability, of equanimity, you can then make better decisions in the market. And I feel this is so important in trading, because we're often, look, the market is really good at pushing our emotional buttons. You know, we get greedy, we get fearful, and this is normal because money is on the line, and money has such a power on our psyche. And but this is why I think that meditation and trading works very well together, because if you can implement that practice, adopt it, make it part of your day-to-day life, and once again, you don't have to do it for extended hours, just 10-20 minutes a day, preferably in the morning, right before you're about to trade. And just calm your thought processes, become aware of your emotions, the good, the bad, stay with it with friendliness, and see what those things are, what they are as physical phenomena, because when you observe a thought objectively, what you notice is that you'll notice certain characteristics. A thought is, when you're able to notice it objectively from a distance, while not getting englobed in the thought itself, but you're really observing it as it is, as the phenomenon, as the phenomenon that it is, you notice that first, that it's impermanent, very impermanent. One moment it's there, the next moment it's gone. The moment you direct your awareness on it, on a thought, it's not there anymore. It just dissolves. So why does thought have so much power over us in our day-to-day lives, given how insubstantial they are? It's like, it's a mystery. It's not really a mystery. I know why they have so much power over us, because most of the time we're unaware of them. We haven't practiced this awareness muscle that we all have within us to sort of help us notice when they're arising, so that they don't have that much control over us. So when you see a thought arising, you notice it, and if it's a thought that's telling you to, to FOMO into a trade without structure, without a plan, so that mindful awareness, when you cultivate it, it gives you that space to notice and to then make the decision, the wise decision, to not feed it, right? And when this is practiced and developed and fully rehearsed through a consistent meditation practice, it's powerful, man. It really is. So that's what equanimity is. It's not, it's a practice. Okay, it takes repeated seeing and learning to develop that quality in the mind.
And I think a lot of the misunderstanding around it is like meditation isn't sit still for 20 minutes and then go about your regular day. You're strengthening a muscle of building that awareness that you're not just going to get up from your 20-minute meditation and forget, but over time, you're also building the ability to have that awareness at any moment in your day. And that's the very important part about this practice, is to build that muscle and strengthen your awareness of yourself.
Right. And as you said, it's to seek to implement it in your day, because look, it's not useful to be equanimous and calm and composed while you're sitting in meditation on the cushion. And once you get up, you're the biggest jerk out there to others and to yourself. It's not helpful, so you need to find a way to bring the practice into your daily life. And life isn't easy, you during moments of difficulties and of challenges, these are opportunities for you to practice that quality of mindful awareness that you've been cultivating on the cushion. Because it's very difficult to be calm and composed and equanimous when everything is going well in life. But what's the purpose of that? What's the merit in that? The true merit comes from being able to practice this and that mindful awareness in the very midst of confusion, of vicissitudes, of turmoil, of challenges, difficulties. This is and this is something that I'm still working on. It's a work. I'm a work in progress, and it's a lifelong sort of journey.
Tessa has a question. You mentioned meditation as one of the ways to apply and practice experiential understanding. What are some other ways that you have also tried?
Well, the other way, perhaps more important way, is that you have to, once again, if you want to get better at trading, if you want to learn to espouse uncertainty more, you got to trade more, not less. Okay. To use the analogy that I used earlier with swimming, if you want to learn to swim, you got to jump into the water and swim more, not less. If you want to learn to play guitar, you got to pick up the guitar and play as much as you can. This is the nature of mastery right there. It's not just reading a bunch of books and you're watching a bunch of videos. I'm not saying those aren't helpful. Those are very helpful, but that's only the sort of conceptual understanding I talked about earlier. You need those two, conceptual and experiential, and this, when they converge, this is mastery right there. So you want to work on both, side by side in a balanced manner. And yeah, so get into the field, trade small sizes so you don't blow up. If you're a new trader, you're not in a position to make money yet, and you have to understand this. Yes, the market can hand you profits here and there. That's what it does. You don't need any skills at all to make money from trading, but can you make consistent money as a trader? This requires a lot of skills. It requires a lot of self-control. It requires a process, a winning trading strategy, and understanding of the market, and understanding of probabilities, and understanding of uncertainty. And so those take time to develop. So if you're just starting out, try not to focus too much on making money. Just imagine that you're going to school for 2 years, 3 years, and that you're learning a craft that's going to earn you a lot of money later, but not now. Right now, you're just learning, okay? And you're going to make mistakes. You're going to lose money. Just make sure that you're not losing too much so that you can stay in the game, right? And so that you can keep learning. If the market boots you out of the game, you're not going to learn, right? That's why small sizes when you're trading, when you're learning to trade, is so instrumental. And actually, this is a big habit that I've kept myself. I've noticed over the years, because I've been trading for a very long time now, and I'm just not good at trading big sizes. I get emotional. This is who I am as a person. So now, nowadays I trade a rather large account for myself and for a small group of investors, a multi-million-dollar account. But even then, my risk on a per trade basis, very, very small, Nicholas. It's like, 0.5 to 0.6% on a per trade basis. So what this does is that it allows me to place a lot of trades because I'm playing the numbers game, right? Without blowing up. And so basically I'm using 0.5 to 0.6% as position size on a per trade basis. And this allows me to place my stop, not based on some arbitrary monetary concerns, but based on where it makes sense the most. Okay. And so as you can imagine, when I get stopped out of my trades, I lose way less than 0.6%. Right. And so this is what I do. I'm playing the numbers game, and I'm very conservative in my trading. I'm done with the years now where I'm 41 years old soon, and so I've come to this point in my life, in my trading, where I'm just very conservative. I'm over this period of having just big swings in my equity curve. I really enjoy having a slow, steady growth in my equity curve. But look, there are many different strategies for many different personalities out there. That's perfectly fine. If you like to trade big sizes and just swing for the fences, it's just fair enough, man. But you got to expect that you're, a lot of volatility in your equity curve. You got to expect that you could blow up, on any trade technically. But yeah.
I know I've advised people before too that are getting new into trading is like trade 3 shares at a time, trade 2 shares at a time. But I understand how boring that sounds too, because going back to the topic of instant gratification, people get into the market for one reason. They want to make money. And especially a lot of the people who are coming from like the financial Twitter world or the Instagram, and they see these gurus promising 80% win rates and making 10 to 20% a week. And it's just so damaging, I think, to newcomers to then hit the wall of reality where that's just not what you get.
Yeah, absolutely. You make a great point. And this basically I mean, it connects to a point that I want to make about how I run my my trading business. I mean, I've been in the trading arena for, as I said, for many years now. And for the past 11 years, I grew about 14K to well over $7 million, my own personal money, by the way. And I rarely withdraw from my trading accounts. Profits, they stay in the account and they're methodically reinvested. And you know what? I earn my living. My monthly income, I earn it through real estate, through dividends from stakes that I have in other small businesses, from content creation, my work with Trading Composure, and other small ventures and pursuits like that. But this is how I do things personally. And I mean, it's worked tremendously for me because my profits, they stay on my account and they compound. And so I'm not saying that you should do things like me, but ideally, this is a way for you to not be to not have this this pressure to perform in the market because you're not using your trading profits to pay the bills, to pay your mortgage and so on and so forth. So this is what I talk about in my trading for a living course. I try to open people's minds, perspective a little bit when it comes to trading in this day and age. You got to find a way to develop different streams of income that aren't contingent upon market fluctuation, and this will decrease performance anxiety, because mindset, your trading psychology, is a big part of trading success. And if you're constantly anxious and constantly wondering if you're going to make money or not, or taking unnecessary risks because you need to pay the bills and all of that, it's just going to be very difficult for you. So find a way to create different streams of income that aren't dependent upon market fluctuation, and see what happens.
If no one else has any more questions, do you want to go over how anyone watching can get a hold of you if they are interested in your services or your social media?
Right. So basically, people can follow me on social media if they want to. My handle on Twitter is @tradingcomposure without the E at the end, and I'm I'm on YouTube as well. Just type Trading Composure, and that's basically it. Most of my stuff, most of my content that I put out there is free, and you can learn a whole lot, with me, just with that free content. And if you want to explore eventually, some information that's more, how do you say, more structured and more organized, then check out my paid stuff. But you don't have to, you can learn with the free content, because it's the same thing, really. It's just that with the paid content, it's more structured, it's more organized, and it gives you a way to sort of to not have to dig information right and left to find things that connect and that are relevant to your specific case. So it's more structured, it's more organized, but the free content is fine. Just check that out and learn as much as you can. Absorb what is useful to you, discard what isn't, and keep learning, keep growing, and keep evolving. I wish you all the best. In this field, it's not easy. It's really not, because because of the trading psychology element. It's not easy, but I hope you have the resilience and the commitment that's necessary, and the sincerity that's necessary to make it in the long run, to stay in the game, and to eventually experience success. Because if you do have that, you will eventually make it. So keep working, keep growing, and I wish you all the very best.
Oh, thank you. I would like to ask one off-topic question of you. Since you are here, and this is for the Chat with Traders community, we recently launched an accountability program for people to join, to both have one-on-one conversations with an accountability partner, but also we do group meetings on the weekly. Since you've been doing this for several years, do you have any advice for both holding a partner accountable, but also what ways do you hold yourself accountable to stick to your rules?
Right. So personally, my investors hold me accountable, because they're expecting performance from me, and I mean I have to say it's given me a certain level of performance anxiety. I have to be honest, that it's made things a little bit more stressful for me. But I do see how important this is. And look, one of the main reasons why institutional traders outperform retail traders like us on a yearly basis is because they have this accountability manager, this risk officer that's behind their back, that's looking over their shoulders, and that's making sure that they're sticking with their risk allotments, that's making sure that they're sticking with their trading process and all of that. us retail traders, we don't typically have that. Right from the get-go, we're our own boss. We work for ourselves, by ourselves, which is great. I mean, it's great in the long run. But when you're still learning to develop competence as a trader, it's a massive disadvantage, because basically you're left relying on your own, just emotions and impulsivity and all of that. And just it's so easy to hop off the consistency bandwagon. But when you have an accountability partner, and it's great that you guys are offering this. I mean, it's amazing. This is what works. Okay. And this can help you stay on that consistency bandwagon more easily, than if you were to do it on your own. And so this is great. Yeah, and it's it's also important not to, personally, I get a little stressed by it, because I do very well on my own. I'm just, once again, I'm a massive introvert. I work very well by myself. I'm a very consistent trader. But nowadays, since I've been working with investors for the past year and a half, there's this element of, okay, so they're constantly worried about, especially when there's turmoil in the market. The phone is constantly ringing, and I have to sort of adopt this sort of like psychologist kind of persona to sort of help them calm them down. And I'm not good at this. I'm good as a trader. I'm very consistent, but now I'm having to take care of other people's emotions, and it's a real pain for me. But it is what it is. That aside, the consistency program that you guys have on, that are offering to traders, it's amazing. This is how you grow. This is how you evolve as a trader. This is how you stay on the consistency bandwagon. So congrats on launching that. And yeah.
Yeah, thank you. I know for me personally, last year I cut off Twitter and social media to focus on my own personal trading. But then that also created the new problem of loneliness, and then being stuck in my head with just me and a screen.
Right.
And then ever since we've started this program, it's just amazing to have other people to talk to and reach out to, and your emotions just flatline, and it makes it so much easier for you.
Yes.
So if you are checking this out on YouTube, you can find out more at the Chat with Traders website about both the community and the Trader Accountability Program. But thank you for joining us, Yvan. If you didn't catch it, he is the man behind Trading Composure, and you can find him on all social media. And thank you for joining us today.
Thank you so much for having me on, and for allowing me to sort of explain a little bit more, what I meant by uncertainty, because I feel like this was lost on a lot of people. And, once again, understand this, internalize this concept of uncertainty, and I promise you will make giant strides of progress in terms of consistency in your trading.
For sure.
Thank you, Yvan, for coming back to speak with us. The community here and the wider trading community appreciates all the work that you do.
Thank you so much for having me on, Tessa, once again, Nicholas, and I look forward to having a conversation with you guys again in the future.